Jeremy, thank you for that introduction, and thanks to all of you for being here. Over the past 6 months, a variety of different formats for the conference agenda have come across my computer. As is oftentimes the case with these things, you don't really know what you're going to talk about until you read the marketing materials. Apparently, I'm here to talk about traditional investing, computer-based trading, and the dynamism of the financial marketplace. Had you asked me about a month ago, the latest version I had suggested I'd be talking about flash crashes, progress traps, whatever those are, and self-reinforcing progress feedback loops, ever-growing financial information, big data analytics, and the value of human insight. Over-complexity, could it endanger the framework of trust? Taken together, it would appear I could talk about anything I wanted. But if I did try to talk about everything, you guys would probably get me out of the room. So considering my audience, and that it's a pretty broad range of industry members, I'd like to spend the few minutes I have up here, and I do want to stress the word few, to talk about a couple of ideas that most, if not all of us, are either actively thinking about or are highly affected by every day. Before I do that, however, I should say a little bit about my background so that you understand the point of view that I have. I spent the first 5 years of my career making markets in an equity option pit at the CBOE. I've spent the last 10 years at a primarily electronic market making firm that specializes in equity options, not spot trading. That vantage point has exposed me to most, if not all, of the significant trends that have become standard fare for discussion at conferences such as these for many years. In assessing the state of our industry, and U.S. equity market structure in particular, since it affects spot so directly, the word complexity gets bandied about, well, just about everywhere. Of particular interest to us as practitioners is the nature of that complexity. Is it really complex, or is it just complicated? And how we should be thinking of engineering our businesses, or, depending on your point of view, servicing your customers, in light of that complexity. You all probably have a different definition of complexity, but mine is this. I think complexity exists to the extent a given system has the following property, in that it's difficult, if not impossible, to learn why the system is behaving in the way it is, even though one might understand all the rules that make up that system. The operative word in that statement, of course, is learn. All of us in this room, and all of our colleagues not in this room, do need to learn about the system of markets, and particularly our proprietary systems, for operating in them. Learning is required for us to understand how to add value in any system, particularly economic ones. Learning creates adaptations, and adaptations are what allow systems to evolve and compete more effectively in their environment. Learning in U.S. equity and equity option markets has become a Herculean task in and of itself, and I find that to be a problem. I believe that this factor will influence the future of our businesses more than any other factor over the next 10 years. One needs to look no further than the demographics of our industry to see how we've approached this problem. The guys talking at the urinals in trading places have been replaced by engineers, physicists, and computer scientists. Incredible problem solvers. Folks that have skills in understanding, describing, and creating systems. People who can flat out learn faster than their predecessors could. But for all the structure, order, and deterministic logic folks such as ourselves infuse into the marketplace, the environment we are designing for and reacting to has not become less complex. It has not become more ordered. In fact, quite the opposite has happened. My ideas about complexity have been highly influenced by a man by the name of Steve Wolfram. Mr. Wolfram is a very smart man. You might know him as the founder of Mathematica or as the progenitor of Wolfram Alpha. He actually should be at this show. But while Mathematica is busy giving closed-form solutions to problems in multivariate calculus, and Wolfram Alpha is giving us precise information to common questions like what's the cost of 300 kilowatt hours of electricity in Illinois, Wolfram's longest book was all about how we think about complexity. Many a smart person has fallen asleep in the middle of its first pages. For those of you who would rather not be weighed down by such a heavy book, and by heavy I mean this thing weighs a ton, I can summarize it with two big ideas that are very relevant to our industry, both macroscopically and microscopically. The first idea is this: you can get complexity from very simple algorithms. He uses a device in the book, a device I'll try to show you here on PowerPoint, where we can think of each row of this grid corresponding to a snapshot in time, where we're going to decide whether to turn a cell black or white on the basis of what we just saw on the row above. You can think of this black-white decision as having a parallel in the decisions we make in our computer systems billions of times a day, if not more. So whether you think of this black cell as yes or no, trade or no trade, true or false, it doesn't matter how you think of it, you can get it to work for you. So we start with a signal because we have to initialize the system somewhere. Then we have to apply some rules to the system to have it make decisions for us on the basis of what it just saw. These rules are exceedingly simple. In this case, we have 8 different conditions to react to, 1 decision to make, and only 2 possible outcomes for that decision. So we apply these rules, and little by little, the system evolves. And you'd think that these simple rules will yield a not so interesting picture of the consequences of simple rules. And you'd be wrong. As it turns out, these simple rules yield highly complex behavior, which gets us to our second idea. See, it turns out that, despite the simplicity of this business logic, it is actually quite impossible to predict what the picture is going to look like. You actually have to run it to find out. And it happens to be irreversible. If I want to predict what color the middle cell in the 1000th iteration of this business logic will be, I actually have to run the thing through, which renders prediction meaningless and has important consequences for us as risk managers. These two ideas, that you can get complex outcomes in even the simplest of algorithms in a feedback loop, and that there is really very little, if anything, one can do to predict the outcomes in advance of running the systems, are, I believe, of critical importance to everyone from Mary Jo White, thinking of US market structure, to Joe Algo Trader, proprietary trading firm XYZ. Why? In complex systems, getting true alpha, information, signal, versus just getting noise is very, very hard. How hard is it? There are approximately 800,000 individual option contracts quoted in the United States every day. Each one of those options is quoted on over a dozen exchange platforms in real time. Thanks to Jeremy, we will soon have more. As those options are being quoted, prices and size changes are very frequent. How frequent? The peak volume of this system was about 7.8 million messages in 1 second. Over the course of a regular day, tens of billions of messages are being processed by market participants. This compares to trading volumes that have averaged in the neighborhood of 15.9 million contracts per day in 2015. My back of the envelope says that the density of actual volume, think of it as signal, to simple quote updates, think of that as relative noise, is on the order of about 1,500 to 1. But alas, you would say, we have computers, and computers scoff at problems like this. My reply would be this. Say I gave you credit for being able to process all that data, but what do you do with it? The only way to get real value from processing this data is to apply something that you've learned. The fancy word we use for that is intellectual property to it. At some point, a human has to be involved to either explain what's happening or to create the models that end up doing the explaining for us. But consider that explaining what's happening in and of itself requires us to know what's happening. To construct a story of what happened when, to forensically deconstruct a sequence of events, and come up with a precise accounting of the narrative of US equity and equity option markets on any time scale. All things that facilitate true learning, mind you. That's really hard. Fragmentation in our marketplace has created parallelism, but it also fosters an environment where market participants are forced to model the problem quite inexactly and imprecisely. just to make it even remotely manageable. For the punchline of this line of thinking, look no further than our regulators. At the end of the day, for the regulatory infrastructure to function well, the regulators have to be equipped to understand the activity that they are policing. And I think the tide is turning in favor of streamlining and simplifying market functioning. Why do I say that? 5 years ago, the SEC published its original verdict on the flash crash. 5 years ago, the SEC clearly thought the flash crash was about market makers, algorithms, and some selling and buying. But as the word count suggests, there were obviously more sellers than buyers. The folks on the front lines saw the market failure as algorithms reacting to complexity. More recently, however, there are signs that the mindset has shifted. To wit, Mary Jo White recently asked these questions of our markets. Why are there 11 exchanges that trade listed equities? Why are 10 of these exchanges controlled by 3 exchange groups? Why are there hundreds of different order types across the various exchanges? Why are 94% of displayed orders in corporate stocks canceled without an execution? Why are more than 50% of the displayed orders at the best prices in corporate stocks canceled in less than a second? Why are there more than 40 dark pools? Why in a single week were nearly 2.9 billion orders routed to dark pools, yet only 1% of these orders actually received an execution? These questions all hint at an idea that the amount of noise in our markets is impeding learning. I think that market functioning in the next 10 years will be highly impacted by the trend of simplification. What are the consequences? In our world, much of the edge that was earned by trading firms over the last 10 years involved exploiting gaps in market participants' abilities to handle complexity. Anybody who wasn't current on fee structure or had blazing fast market data infrastructure was necessarily paying significant economic rents to the folks that were, and with the size of those gaps scaling in times of high volatility. If my thesis is correct, that markets in the US will simplify in terms of their functioning over the next decade, execution-driven edges will decline further, will accrue to a broader range of market participants, and force firms to compete on superior strategies for managing inventory over longer periods of time. The typical profit center method of organization in this industry may have to be rethought to encourage a learning organization where ideas are more broadly shared and built upon. If I'm wrong, I think the keynote speaker at this conference 10 years from now will be speaking to a much smaller audience. After all, the reason any of you are even here is because you have learned enough through all the complexity to add value. And there are fewer of you than there were 10 years ago. The only question is whether the problem gets harder or not tomorrow. I want to thank all of you for your time and for not bringing tomatoes today. Please enjoy your experience at this conference. I hope you learned something. There's that word again. And with no further ado, I will bring up Jesse Collin back up to explain the rules of the game with respect to speed networking. Thank you.
Carlos, we can take some questions. If anyone has any questions for Carlos.
Still time. Yes.
What do you think, if you had to forecast sort of the first, like, simplifying regulation changes or timeline, what do you think? What's your best guess?
I mean, given that the conversations are happening now, I think it's a sure bet something will happen in the next decade. And some of the proposals that have been out there in terms of requiring, minimum price improvement increments in dark pools, having to trade at the midpoint, if at all, restrictions on access fees. Those are all items that have, for how innocuous they seem, have very far-reaching effects on the structure of markets, just like Reg NMS did with all its well-intended verbiage. So, given that the whole basis of what I spoke about was that very simple algorithms can have very far-reaching consequences on the system, very simple changes in the rules of the game can have a very big impact on what we will be seeing.
Questions for Carlos?
Yeah.
Carlos, you mentioned the regulatory environment kind of really closing there. How is that impacting, I guess, spot trading, your role, your responsibilities, and what we consider the broader spectrum of trading groups today?
You know, in my role in my day-to-day, which I think is what we're all interested in when we go back to our offices, there's certainly a lot more compliance. I interface with my compliance department multiple times a week. We talk about you know, the amount of things that we as trading supervisors have to actually sign off on. That's kind of tip of the iceberg. In terms of other stuff, I think we've had to be a lot more careful in the way that we structure our strategies. Try to make sure that, if at all possible, avoid a lot of overlap in the products that we trade across business groups. That, you know, in the end, if the regulatory framework can't get their heads around 5 trading groups in one company all trading the same product and how that actually works, that could have an impact later on. But you know, really on a day-to-day basis, it's more you know, stuff we see out on the horizon that I know will affect us later on. It hasn't really, you know, the wave hasn't actually crashed on shore yet.
Got time for maybe 1 or 2 more if anyone else has a question.
I promise it'll be an easy one. Can you talk a little bit about how some of the underlying technologies that you guys use, I know that the firm has evolved over the past 4 or 5 years, but how have those technologies that you guys rely on day to day, how have some of those things changed?
Well, we've spent a lot more time getting down to the atomic level of what's going on in markets. And that's something that Spot, its pedigree, for those of you who don't know, is actually we were a so-called market taker, very much assuming that we would be warehousing inventory for a very, very, very long time, you know, measured in months, if not years. You know, that's changed somewhat, and with it, you know, needing to drive understanding of what's going on at the very basic level has come, you know, our packet capture and you know, technologies that let us sort of aggregate all these disparate forms of information, sequence them, try to integrate it with our own responses, try to step through business logic, you know, one decision at a time, one piece of data at a time. That's all, you know, pretty non-trivial stuff for firms such as ourselves, having come from really nothing. So, you know, that's probably been the biggest thing that I've, you know, observed at Spot. It's been our attention to detail at the very lowest levels of you know, market data.
All right, we have time for maybe 1 more if anyone else has a question for Carlos. All right then, I appreciate it. Thanks, Carlos. And everyone stay still just for a minute.